In the year 2015, there is a sum of income from house property, that is from question number 5. It is a 10 marks question. What informations are given there? Sri Gautam Pal is the owner of 2 houses in Kolkata. Information relating to the 2 houses for the previous year 2015-16, I have changed it with 2021-22. Yeah, are as follows. What is this? Municipal value, gross municipal value for the both houses 3 lakhs and 2,50,000. Fair rent 2,50,000 and 2,90,000 respectively. Standard rent is rupees 3 lakh for the let out house. Annual rent is rupees 2,40,000 for the let out house. Vacancy period is 2 months. Municipal tax 27,000 for the first house, and for the second house 25,000. There is a printing mistake, that is under 25,000 it is written within bracket that out of which rupees 8,100 paid by tenant. In case of self-occupied house, this cannot be happened. So these within bracket phrase, this will come under this rupees 27,000. That means for let out house, total municipal tax is 27,000, out of which 8,100 is paid by the tenant. And interest on loan for the construction of houses 45,000 for the first house and 75,000 for the second house. Compute income from house property of Sri Gautam Pal for the assessment year. Change it as 2022-23. Now this is the answer part. First we have to write the heading, where I have written SSC, name of the SSC, he is Sri Gautam Pal. Heads of income is income from house property. Previous year, okay, previous year I have taken as per the question, that is 2015-16, and assessment year as per the question 2016-17. In your case, your relevant previous year and your relevant assessment year should be written here. In case of particulars, there are here in the sums portion, there is 3 amount column. First house, that is house 1, that is let out as per given in the question. First we have to calculate gross annual value. For gross annual value, there you know that there are 3 steps. For in step 1, we have to compare these 3, that is gross municipal value given in the question 3 lakhs, fair rent given in the question rupees 2,50,000, and standard rent given in the question 3 lakh. By comparing these 3, we came to step 2, that is called reasonable expected rent. And what is that? That is the higher of GMV and fair rent subject to maximum of standard rent. Now here gross municipal value is 3 lakh, fair rent is 2,50,000. So comparing these two, we get that gross municipal value of 3 lakh is the highest, and comparing with standard rent, these cannot exceed standard rent. So gross municipal value and standard rent is equal. So reasonable expected rent must be rupees 3 lakh. In step 2, we have to compare these 3 lakh of reasonable expected rent with annual rent. It is also given in the question, that is 2,40,000. So comparing these two, we get in step 3 higher of step 2, that is 3 lakh. Comparing this 3 lakh and 2,40,000, higher is 3 lakh. So we have taken this 3 lakhs as higher of step 2. Now we have to reduce the loss due to vacancy. Now what is loss due to vacancy? Loss due to vacancy for first house, total annual rent is rupees 2,40,000. This is for 12 months period rent. So we have to divide this by 12 to get 1 month's rent, and vacancy period is 2. So multiplying by 2, we get rupees 40,000 as loss due to vacancy. Now we have to reduce this 40,000 from step 3 and we get the gross annual value of rupees 2,60,000. This is the gross annual value. Now the second part is after computing gross annual value, we have to deduct municipal tax paid by the owner. We know there are two conditions for getting municipal tax as deduction. Number one, it must be paid. Any due municipal tax is not allowed as deduction and it must be paid by the owner. Here in the question it is given total municipal tax is 27,000, out of which 8,100 is paid by tenant. So these 8,100 should be excluded from this 27,000 as it is paid by the tenant. So after deducting this 8,100 from the total municipal tax of rupees 27,000, we get 18,900, which will be available for deduction. So from this gross annual value, we deduct this municipal tax paid by the owner 18,900 and there is a net annual value. We can say it as NAV, NAV, not NAV, NAV 2,41,100. This is the net annual value. From this, there are two deductions. We know only two deductions are available under section 24. First deduction is standard deduction, which is at the rate of 30% on NAV. Now NAV is 2,41,100 and 30% of this is 72,330. And interest on loan is given in the question, that is rupees 45,000 for construction of the house. It will be available as deduction and there is no maximum limit for let out house. That means total deduction is the summation of these two and this is 1,17,330. So this should be deducted from this 2,41,400, that is from net annual value, and we will get this income from first house 1,23,770. From here we came to next page and carry forward this income from first house 1,23,770 here. Now the house 2 portion, that is self-occupied, given in the question. We know annual value of self-occupied house under section 23 subsection 2 is nil, that means 0, and only one deduction is available from the annual value of self-occupied house, that is only for interest on loan. Interest on loan is given in the question, that is rupees 75,000 and it is within maximum limit. We know the interest on loan, maximum limit for interest on loan for the construction of the house for self-occupied house. There is a maximum limit, that is rupees 2 lakh, and this 75,000 is within the limit, so it will be allowed as full deduction. So from the 0 we deduct this 75,000 and the income from second house will be negative 75,000. So there is an income from first house and there is a loss from the second house. So this loss can be set off from the income from the first house and it comes 48,770. That is the total income from house property of Mr. Gautam Pal. So this is the total answer. In case of question number 5 odd, there is a total sums on question number 5 of 10 marks and there is a alternative question and there are 3 parts of this alternative question. For the number A part, what is that? State the deduction available under section 24B of the Income Tax Act excluding interest for pre-construction period, we know that under section 24B is the deduction of interest on loan, and that has two parts. One is pre-construction period and another is post-construction period. Pre-construction period interest on loan is not included in your syllabus, so we have to deal with only post-construction period interest, and here it is mentioned that excluding interest for pre-construction period from the annual value of the one self-occupied house. This is very much important in case of self-occupied residential houses for in respect of interest on money borrowed. Now we know in case of let out property there is no conditions for interest on loan, or we can say there is no maximum limit. But in case of self-occupied house, there are some maximum limit of interest on loan. Here you have to mention that. How will we write this? Question is that deduction available under section 24 clause B for self-occupied house. What is that? Number 1, loan taken for construction of house or purchase of house. There may be two conditions, there may be two situations, not condition. One, house loan is taken for construction or acquisition or purchase of house, or loan is taken for repair of house. So in case of loan taken for construction of house or purchase of house, there are some maximum limit. What is that? There is also two part. One is called if loan is taken before 1/4/1999. Suppose the date of loan taken lies before 1/4/1999. Maximum of amount of deduction is rupees 30,000 in that case. Suppose the loan is taken on 30th September 1998. That means it is before 1/4/1999. So if the house is self-occupied, in that case maximum amount of deduction is rupees 30,000 according to assessment year 2022-23. I have mentioned it because in case of other assessment year it may be changed. So in case according to assessment year 2022-23, it is mentioned that the amount is rupees 30,000 for maximum limit. But if the loan is taken after 1/4/99, that means any date which is after 1/4/99, if loan is taken on that date, in that case maximum amount of deduction is rupees 2 lakh according to the assessment year 2022-23. According to 2022-23, it is mentioned in the section 24 clause B, the maximum amount of deduction for self-occupied house where the loan is taken after 1/4/1999 and the loan is taken for the construction, acquisition or purchase of house, the maximum amount of deduction is 2 lakh. Number 2, if loan is taken for repair of the house, in that case there is no bar of this date. In case of repair of house and the house is self-occupied, in that case maximum amount of available deduction is rupees 30,000. I have given here a note. If loan is taken for any other purposes, suppose loan is taken by mortgaging the house for child's marriage, not child, daughter's marriage. If loan is taken for child's educational purpose by mortgaging the house, in that case that interest is not allowed as deduction. If only loan is taken for construction, purchase or acquisition purpose, in that case this is available as deduction. But in if the loan is taken for any other purpose, is not allowed as deduction. Deduction, another thing is that deduction is available as per due basis. That means if in any case loan interest on loan is not paid but it is due for that year, then also this interest on loan is allowed as deduction. Payment is not mandatory. If it is due, in that case this interest on loan is allowed as deduction. Another small sum is there, that is net annual value of a let out house is rupees 3 lakh. Interest on loan taken for construction of the house paid during the previous year 2021-22 is rupees 2,50,000. Calculate income from let out house for the assessment year 2000. This will be 2022-23. 2022-23. This is the assessment year. Okay, that means net annual value is given and interest on loan is given, and the house is it is a let out house. So for the solution of this question, you can write the heading in this way also, that is income from house property for the previous year 2021-22 relating to the assessment year 2022-23. Net annual value is given in the question, that is rupees 3 lakh. Deduction under section 24 clause A, there is a standard deduction at the rate of 30% of net annual value, and 30% of 3 lakhs is 90,000, and interest on loan paid rupees 2,50,000. We know there is no maximum limit of interest on loan in case of let out house, so the entire amount will be allowed as deduction. So total 2,50,000 is allowed as deduction. So total deduction available is 3,40,000. That is the sum total of this rupees 90,000 and 2,50,000. It will come 3,40,000. So from the net annual value, we have deducted this 3,40,000, and which comes a negative income of rupees 40,000. That means here, though it is a let out house, then also it can be happen that there will be a negative income will come. One question comes sometime that when income from a let out house can be negative, in that case your answer should be total deduction available including standard deduction and interest on loan. If total amount of this deduction exceeds the net annual value, in that case the income from that house may come as negative. Okay. Another question is there, that is Sri Ravi Roy is the owner of 2 houses. Compute net annual value of the house properties for the assessment year 2016-17 from the following information. Information is given as first house, second house, municipal value, fair rent, standard rent, rent receipt and municipal tax. From these we have to compute net annual value. Assuming that the houses were let out. It is not mentioned here, so we have to assume that the houses are let out house. Now here is the answer part. Assessee, name of the assessee Sri Ravi Roy. Previous year I have changed this as per your, that is previous year 2021-22 and assessment year 2022-23. Here I have made 2 column for 2 houses. In case where income from house property is not required, only gross annual value or net annual value is required. In that case we will make separate column for separate houses. But in case where we compute the income from house property, in that case we don't have to make separate column for separate houses. Okay. So first column for first house and second column for second house. In case of step 1, there is two information: municipal value, fair rent and standard rent. It is written here: municipal value 40,000, fair rent 45,000, standard rent 37,000. And in case of second house, municipal value 29,000, fair rent 39,000 and standard rent 41,000. In case of step 2, reasonable expected rent, what is that? Higher of GMV and fair rent subject to the maximum of standard rent. Now, in case of first house, higher of municipal value and fair rent is comparing these two, 40,000 and 45,000. The 45,000 is the higher amount, but it exceeds standard rent. So we have to take this standard rent as a reasonable expected rent. And in case of house 2, when we compare these two, municipal value 29,000 and fair rent 39,000, higher is this 39,000 and it does not exceed standard rent, which is 41,000. So this 39,000 will come as reasonable expected rent. Annual rent is given in the question, that is 41,000 for house 1 and 35,000 for house 2. Now step 3, there is no vacancy period, so we will straight come to gross annual value. And gross annual value is higher of step 2. That means comparing these two. Comparing these two, that is reasonable expected rent of 37,000 and annual rent of 41,000. Comparing these two, we will get this one is higher. 41,000 is higher. This should be gross annual value for the house 1. And in case of house 2, 39,000 is reasonable expected rent and annual rent is 35,000. By comparing with these two, we get 39,000 is higher amount. So this will come as gross annual value. From these we have to deduct municipal tax. Municipal tax is given in the question for house 1 3,000 and for house 2 2,500. So deducting these two, we will get for house 1 38,000 is net annual value and for house 2 36,500 is net annual value.